I'm Sarah Williamson, and this is Going Long with FCLT Global. On this show, you'll learn what it means to be long-term from the top minds in global business and investing. Leaders from companies and investment organizations join us to discuss how they are leading their teams for the long run on issues including capital allocation, risk management, climate change, and sustainability. To learn more, visit our website at fcltglobal.org.
Today, our guest is Matt Whineray. Matt is the Chief Executive Officer of the New Zealand Superfund. Matt was appointed Chief Executive Officer in July of 2018, and he's responsible for the general management of the fund. He was the Chief Investment Officer since 2014, overseeing the development of the fund's climate change strategy, risk allocation process, and risk budget framework. Prior to that, Matt was at Credit Suisse in Hong Kong, where he was head of financial sponsor coverage. Matt is a longtime supporter of FCLT Global and has previously served as a member of the World Economic Forum General Agenda Council on the future of investing. So, Matt, thank you so much for joining us today.
Thanks, Sarah. Lovely to be here.
So let's just start for our listeners who are less familiar with your fund. Can you explain the origins and the purpose of the New Zealand Super Fund?
Sure. Well, this is really good timing to be having this conversation because next Monday is the 20th anniversary of the Super Fund's legislation coming into force. So in 2001, the act was passed, which created the Super Fund and the Guardians, which is the management entity. And we started investing in 2003 because it took a little while to appoint a board and get some people on board and get going. That legislation was passed to create essentially a save as you go scheme. So in New Zealand, when you turn 65, there's a universal pension. We call it national superannuation. Hence our name, Guardians of New Zealand Superannuation. And everybody gets the same amount when they turn 65. And of course, we, like many other developed nations, have an aging population. So could see that we would continue to grow the cost of that universal pension over time as the population aged and we had fewer taxpayers supporting more retirees. And so the fund was set up to smooth out that increasing cost of national superannuation over the long term.
So it's great that the legislation was so forward thinking and sort of planning for this in advance. Now, I understand that you don't have to make withdrawals for another 15 years or so. So that really does make you the quintessential long-term investor. So how do you use that focus on the next generation to influence the way that you invest the fund?
Yeah, that's right. So our withdrawals, buried in that legislation I talked about is a formula which determines the contributions and withdrawals over time. And Treasury, which is our Ministry of Finance in New Zealand, they keep that model and they publish the model and they update it each year. And that shows what that contribution and withdrawal track looks like. At the moment, it's forecasting withdrawals to start in the mid-2030s. At the moment, that's not a significant withdrawal. It's less than 1% of the fund each year, but then it starts to step up a bit in the mid-2050s. So that's really when, middle of this century is really when we see significant withdrawals starting under that model. But even with those withdrawals, we're still expected to continue to grow as a fund through later this century, certainly as I think peaking as a percentage of GDP, maybe about 2080. So yeah, that makes us a really long horizon investor, a truly intergenerational investor. We're shifting this wealth to benefit future New Zealanders, essentially. What does that mean? It means that, we have to keep our eyes up. We have to care about the value of things over the long term, over the truly long term, as opposed to what's in front of us. And one of the things that this informs is our growth profile in the portfolio. So we have a pretty growthy portfolio by global standards. Our benchmark portfolio has 80% equities in it. So, you'd call that in pension land an aggressive growth portfolio. And we do that because, we're confident that over the long term, we'll earn that equity risk premium from being exposed to that. But we know that that's going to come with plenty of bumps along the way. And we've seen that in the 18 years that we've been investing to date. So, but we can set ourselves up to be able to cope with that volatility, that bumpiness, and to be able to see, keep our eyes up, keep them on the horizon. The other thing that it's had really long horizon was really useful for was how we think about climate change. So we created a climate change investment strategy back in 2016, started implementing it in 2017, and what was helpful about that is that climate change is one of those problems where we don't know how it's going to evolve. We don't know what the destination is. Is that going to be 1.5 degrees? Hopefully less than that, 2 degrees, 3 degrees, or, perish the thought, a lot more. So we don't know where the end point is, and we don't know what the pathway is. And the pathway really matters for different sectors and different asset classes. But and we don't know when it will manifest. But having that really long horizon helped us say, well, we know that it's going to manifest within our time horizon. So within the time, we care about those impacts on the value of the investments in our portfolio over the really long term. And so that helped us, build that investment strategy and say, we've got to deal with this as an investment risk, which is what we've been doing for the last few years.
So we talked to a lot of long-term investors, people who think they're long-term, but I don't think anyone's mentioned 2080 to me in any time recently. So that is very long-term. But to your point, there's no question that by 2080 or sometime between now and then, climate change will have a significant impact. Exactly what it turns out, we're hopeful on. How have you adjusted your portfolio to take that into account? Can you explain sort of how you're baking that in? And it sounds like what you're really thinking about is the impact on the climate on the portfolio, as much as the other way around. So how do you think about the impact of the changing climate on the value of that portfolio over such a long period of time?
Yeah, so we, with a bunch of other institutional investors, we got Mercer to do some work for us as we were building that climate change strategy. And what that said is, okay, there's a bunch of different risks that investors face, and they now essentially kind of boil down into transition risk and policy risk. But there's a bunch of different risks that they face, and those risks will have different impacts on different asset classes or different sectors. And depending on which pathway you go, those risks will be different. So if you have a really, sharp temperature rise followed by a sharp policy response, that's going to be different from if you have a more measured policy response now that allows people to transition and then perhaps limits the temperature rise. So, but what it did tell us is that it didn't matter which of those pathways we're on, global equities would be negatively affected by over the horizon that we cared about, the 15, 30-year horizon. So what we did was say, okay, there's a investment risk, there's a risk baked into our portfolio that we don't think we're getting paid for, i.e. we don't think the market's pricing it that well. Why not? Because it's that problem I described. You don't know where the endpoint is, you don't know what pathway is, and you don't know what the time frame is. So that makes it difficult for markets, which we think are generally pretty good at pricing risks. So what we said is, okay, there's a number of different ways that we need to deal with this. Firstly, we should reduce our exposure to that risk. So we said, let's proxy that with carbon emissions intensity and fossil fuel reserves, and let's reduce our exposure to those things, because we think those are the ones who are most likely to be impacted by this risk, in particular the policy risk. Then we had 3 other streams: analyze, which means let's incorporate climate change in our valuation frameworks as we think about our different investment strategies; engage, which is be active in talking with companies, teaming up with other investors to put, I guess, to improve, 1, disclosure, but 2, to understand what companies' strategies were to deal with this; and then finally search. And what search is about is, when we reduce the carbon intensity of our portfolio, what have we done? We've just sold those shares to somebody who cares less about it than we do, right? So that's not going to change the global picture. It'll change it a little bit at the margin as it changes some companies' cost of capital. But the search one is about, well, how do we put capital to work into investment opportunities that will have an impact on climate change? So exactly your point. The first one is really about what's the impact of climate change on our portfolio. The search one is about what's the impact of our portfolio on climate change. So how can we change or contribute to the transition to a low carbon economy? And so there's those 4 bits are in there, and we've been active with all of those, but the one that probably gets the most attention is that reduce one. So we're reducing that exposure, and we've been doing that since 2017. What we do is we do it basically with our listed equities. That does the heavy lifting. We rank all of the stocks by emissions intensity. We rank them all by fossil fuel reserves, and we knock them out of the portfolio until we hit what our target is. And so we remove a bunch of companies, and actually that's worked really well for us. So it's only been a short time, but it's improved the portfolio returns by about 60 basis points annually over that period. So it's been a positive outcome.
So that's a much more multifaceted, if you will, approach than some people are taking to just, net zero or divestment. And I think that, your point that when you sell something, you're just giving it to somebody who cares less is a critical point that I think is a challenge for a lot of investors and a lot of companies right now, because the easiest thing to do is to get things off their balance sheet, get things out of their portfolio, but they do go somewhere else. So how have you been able to explain that to your constituents in this multifaceted way, a little bit more nuanced than just, get rid of it?
Yeah. That's this goes across the whole responsible investment spectrum, because doesn't matter what it is it something that's carbon heavy or contributing to climate change, or something that a company that has had poor social practices or labor practices or human rights response, often the first response is just, why do you own it? Right? So get rid of it. And our response is, well, engagement is important, because ultimately what we want to do is change practices. We want practices to improve. And so for us, we'll always want to engage first. Now, the exception to that is a number of these sort of product categories. And so in that, we include things like, cluster munitions and nuclear weapons and tobacco, and actually these carbon heavy and fossil fuel reserve heavy stocks, because engaging with people to stop producing those things is probably going to be ineffective. And so in that situation, we're just saying we want to reduce our exposure to that thing, whatever that, however we've come up with that list of things, but we want to reduce our exposure. But we also invest quite a bit of time and money in that engagement side of things, and collaborating with other investors to ask companies to firstly disclose information about these practices, but also to improve practices, because it really, ultimately for all of us, we should be looking for an improved outcome, not just that we've sort of spray and walk away. We're done.
Right. And then can you talk about I think you said analyze was one of the ones a little bit more. So how are you, so I understand the reduce, the engage. I want to come back to the search, but can you talk a little bit more about the analyze bucket? What are you doing there? Yeah,
so our investment team created a valuation framework which helps our investment teams, individual investment teams and analysts, incorporate the different impacts of climate risk. So when I talked about that Mercer report, they had they had a series of risks. They, like all good consultants, came up with an acronym for it. Their acronym was TRIP. So that's technology, resource, impact, and policy, I think it was, which really goes to technology change. The resource, the R and the I are about acute and chronic weather pattern changes, and policy is about basically carbon pricing. So they came up with those four and said those different asset classes will have different betas to those risks. We added a couple of others to our valuation framework, which were essentially consumer demand. So what's the sentiment around different companies? Because that becomes quite a powerful mover of valuations. And then the last one was litigation, because there is increasing climate litigation around the world. Certainly, at the investor level, we've seen it in Australia. We've seen members of superannuation funds in Australia sue the superannuation fund to say you are not taking climate change into account properly, and we want to see that you do that. So, but at the company level, there's been quite a lot of litigation about how companies are contributing to climate change, and different, often they're sort of state and local governments looking to recover the cost of significant damage, mostly weather damage, from companies. So there's been a lot of litigation. So we had these sort of 6 risks, if you like, and a way and so we created this framework to have people think through those risks for the individual companies that they're thinking about, so that we can try and incorporate it. Because what we tried to avoid is just the really blunt way of doing it is to say, oh, we're just going to add something to the discount rate. We're just going to add some premium and we'll run that through. But what this tries to do is to say, how do we think about it in terms of the cash flows? Because ultimately the valuations of these things are going to be, what are the cash flows? What's the expected cash flow profile through time? And what rate should we do? How risky is that? So what rate should we discount that at to get some valuation today? So what we tried to do is get people to think about it, and what's the technology change risk to this company, or what's the physical risk from either acute or chronic weather changes? What's the carbon pricing, carbon tax, carbon price risk from policy changes, and get them to think about that at that valuation framework level. So at the cash flow level, because we want to be a little bit more nuanced than just saying, oh, well, add a 5% premium to the discount rate or whatever. It's not that useful for engaging the conversation.
And so you're really doing that on a company by company basis and thinking about the litigation risk for company A versus litigation risk for company B, and try to understand that is at that level.
Yeah, so just to be clear, we're not running lots of active listed equity portfolios. So we're not trying to do this on a global listed equity portfolio. Others that I've heard talk, I think it was GIC or Temasek, one of those, that talked about the amount of work they're doing on climate change databases, which I was like, oh my God, that sounds fantastic. I'd love to get my hands on one of those. But ours is really, as we think about our direct investment activity, which is a much smaller part of our portfolio, how do we incorporate these considerations in those? But also for our New Zealand listed equities, because we do run an active strategy in New Zealand listed equities internally. How do we incorporate those questions into our relative valuations?
Okay, makes sense. So let's talk about the search bucket. That's where you're trying to do. Is that more of a venture capital mindset of trying to invest in something that maybe solves this problem from a technology point of view, or how do you think about that search bucket?
Yeah, so our search bucket, which in the sort of new sustainable finance world becomes a bit more of a, call it an impact bucket, has to date been a little bit more, not so much at the venture end, but at the development end, and in particular development of renewable energy. So we've had a quite successful strategy partnering with another New Zealand investment entity to develop solar and wind generation in the US. So through a business called Longroad, and so that's been pretty active in building wind farms and building solar farms in the US. And we're also looking at doing that in Europe as well. So that's probably been the biggest chunk of our search. We've done some other stuff which is a bit beyond the venture stage, but in the sort of, you might call growth capital stage, which has been around energy efficiency. So light sensitive or glass that changes polychromatic. So light sensitivity changes. We've seen investment in alternative fuels. So a business called LanzaTech, which makes sustainable aviation fuel from mostly carbon monoxide takeoff from big industrial plants like steel mills, and other investments in sort of waste management space and waste efficiency. So, but to date, it's not been a big part of the portfolio. So really it's something that we've had a good discussion with the board over the last 12 months about, is how do we start pushing that a bit more and scaling that. And in fact, so I was on a call with the One Planet Sovereign Wealth Fund group a couple of nights ago, and a lot of the focus from those very big investors, so the other founding members in that are ADIA, the Kuwait Investment Authority, the Qatari Investment Authority, and the Saudi PIF. They're all massive investors, and they're very, very focused on that impact end of the climate change. So investment in large renewable generation activity. So we would like to scale our focus there or scale our efforts there. But to date, it's been much more at that renewable end. But yeah, the technology and the venture end, that's something that is a bit earlier stage. Well, it's obviously early stage, but earlier stage for us, where we are starting to pick up some of that exposure as well.
Yeah. Well, there are lots of really interesting ideas in that space, and of course they are very early stage. Some of them sound sort of sci-fi like, but if some of them work, that would certainly help us. Well, let me come back to your point on being 80% equities and the volatility that can lead. Obviously, you have a long-term time frame. I remember, I believe you said a couple of years ago when we spoke something like, you can be long-term, but if you get the keys taken off of you halfway through, then you can't execute your strategy. So how do you think about that sort of multi-horizon problem, which is, sure, you're investing for 2030, 2040, 2080, but you've got to keep your board and your other constituents on side from here to there. How do you think about that multi time frame problem?
Yeah, it's a good one, and we've seen a good example of it in the last 18 months of how do you get through that, because it's right. It's a bit of a truism, but if you can't survive the short term, the long term doesn't matter. If you can't survive the journey, the destination doesn't matter. And so how do you set it up for a long-term investor to you still need to be conscious of what's going on in the short term, but not be constantly responding to what's right in front of you. And so when we sort of sit down and say, what are the big risks to a long-term investor? They are the two things that stop you are, you run out of liquidity, so you can't pay your bills when you need to. And the other thing that stops you is getting the keys taken off you, so you lose the support of your sponsor. So the first one, liquidity, we've spent a lot of time investing in or building liquidity management frameworks and building out capability internally so that we can monitor those and respond to changes and manage our fund liquidity. So and then that's about just setting your risk appetite, and that's a discussion that we have with the board. The second one, how do you avoid losing the support of your sponsor? Well, that's something that few years ago, we were quite deliberate about, and I think it was 2018 in our annual report, we published a section which said, well, this is what it will look like if we go through a GFC again, because by 2018, we're now, 10 years down the road, and a lot of that memory had sort of faded. And the other thing that had happened is we're a lot bigger. So, when we went through the GFC, we were about 14, 15 billion. Now we're closer to 60, but 3 years back we were about 40, call it. What that means is that if you go through the same percentage impact that you saw back in 2008, it's much bigger in terms of dollar numbers, and they make for quite scary headlines, as it says, super fund blows $10 billion or whatever it is. So what we wanted to be was really clear with people. So we said, look, our purpose is to be a long-term fund. This is the choice that we've made in terms of setting up our portfolio. And that choice is that we're going to have a significant exposure to risk assets, i.e. equities. That brings with it this is what the journey is going to look like. It's going to be really bumpy. So that's not the risk. The risk is, we know that's going to happen. The risk is that the people who matter suddenly get wobbly at exactly the wrong time, i.e. when you're at the bottom of a drawdown. So as a result, we said, all right, how do we manage that risk? We'll make sure that everybody understands how we expect this portfolio to operate, what it might look like in the short term, be really explicit, take them through a GFC scenario. This will be, X billion dollars of drawdown, and that's what will happen. What was interesting was we said in relation to that, look, the bounce out of the GFC was quite quick compared to historical, significant equity market drawdowns. We wouldn't expect it to be that quick. Well, then we go into last year, right? So you go into the end of February and the market starts, falling, and the market fell until the end of March, and then it ripped back up. But and really fast, much faster than the GFC. And what was interesting was the commentary at the time. I remember I had a radio interview, and I went on the radio interview. This would be late March, and said, yeah, the fund's down about 10 billion now. And if we sort of had been back in the GFC days and we'd been saying the equivalent number, we got quite a lot of commentary saying, oh, you're all a bunch of idiots, and of course you should have had it in bonds, and you should put it there now, of course. But this time around, people understood that. People understood that, and the media understood that we had set up this portfolio deliberately. We were managing it. We expected that we would see things like this, but the key for us was to be able to continue to invest, lean into that. We were buying equities as they fell, and then the markets turn around and rip back up again, and we benefited from that. So and critically didn't take the risk off, and so we've spent quite a bit of time on that education, but that's just an ongoing and forever need, because people change in Treasury, people change, the politicians change. We have to make sure they all understand why we're doing what we're doing, so they're not surprised. I guess that's the key. You don't want to surprise someone with it. So it shouldn't be a surprise if you see a big drawdown, and they should be, the key for them is to understand that it is confidence that we're competent in managing through it. And so touch wood, we're still here.
Well, it's a great way of putting it, that the risk is not that you're going to have a drawdown. The risk is that you're going to get wobbly in that drawdown. And so I think that's because we all know how hard it can be to be be an investor when the market is going against you. And I'm sure there are people who took risk off the table during that drawdown who obviously regret it at this point. But I think that particularly having the media understand that you should be proud of that. That's quite an accomplishment. I find that's hard. Hard to do. Yeah,
it is hard. And this is not to say that was, we were all just sitting around having cups of tea going, oh yeah, that's all right. It is, you're totally right. It is hard going through those things. And And of course, after the fact, when you know where the bottom is, it's easy to be sanguine about it. But when you're in it and you wake up and it's another 2% day, or it's another 3% day, and the fund is, and the, where you're running that dynamic allocation strategy, and the equities that you added yesterday are now worth less, and you're adding some more, that's difficult. But we had a really supportive board. We had a strong, very strong investment committee approach and good understanding of our processes. I remember we've had questions in the past around this type of strategy where you get a question which is, well, what's your stop loss, which is a common trading question. And the response to that was, well, once you stop, you've lost, right? Because the point of a strategy like this is that you're buying on the basis that ultimately there'll be some mean reversion. That's not without risk. Sometimes the mean might move on you, but if it's always going to look worse. The P&L is always going to look worse when the forward-looking returns look strongest, and that's going to be the hardest point to be. But if you can hold on to it there, you can benefit from it, and we saw that.
Right. Well, that's great, and I'm sure anyone who's been in the markets knows what I mean. The S&P, they hit the bottom. You don't know it's the whatever it is. You don't know it's the bottom. So
you don't know it's the bottom. That's right.
It's the bottom until later. That's right.
Yeah.
That's right. Or if it's just another stop on the way.
Yeah.
Interesting. Well, that's great. Now, another thing you've been very involved with, sort of on engagement, but a different way is, unfortunately, New Zealand had this terrible incident in Christchurch, but then you put together the Christchurch Call to try to work with media companies to combat this sort of violence. Can you tell us a little bit about that and what some of the lessons learned there have been about engaging on more socially oriented issues and sort of responsibility of companies?
Yeah, so this goes back to those comments I was making earlier about we'd rather engage than just flat out sell companies where there is an issue. And so in the sort of the awful aftermath of the Christchurch shootings, we, one of the things that really stood out post that was the continued distribution of the video from the gunman, from the terrorist, and the compounding impact that had on both victims' families, but also young people all around the world who were confronted with this. And it was the definition of objectionable content. You could not get any more objectionable. And so what we wanted to see was a much stronger response from the social media companies to sort of preventing the distribution of that objectionable content. And so we, with a number of other New Zealand investors, created a collaborative engagement, which pretty quickly got some really significant support globally from other investors. I think we ended up with more than 100 investors with 13 trillion of AUM. It's always the badge is to say how much AUM you got, but anyway, it's a big number. But there were a lot of investors. We got a lot of really strong support for that, and so we started this collaboration with the large social media companies. What do we learn from that? It's quite hard. Well, we know engagement's hard. It's hard. It's hard because one of the things we really wanted to do was talk to boards, and we wanted boards to take more responsibility for oversight of this. And we said this is ultimately a business risk for you because as a shareholder, as humans we care about this, but as shareholders we also care about this, because if you're going to get regulated, well, the best way not to be regulated is to behave like you are. So start thinking about this and put more effort into it. And so you hope to make changes, and we did make one significant one for us, which was Facebook's risk committee changed its charter to incorporate the oversight of this issue at the risk committee level. So we were pleased with that, and that was we understand a direct response from the engagement. But then I read the news this week. You got Senate hearings going on, and it just shows you that this is a hard thing. One of the things we saw at the time was, so the New Zealand government created the Christchurch Call, which was essentially the same thing, but at the government level. And our one was looking to support that at the investment level. So shareholder pressure, you saw government/regulator pressure, but you also saw quite a bit of consumer demand pressure. And really where you get multiple points of pressure, I think that's where you get the best potential for a change. But I think we do have to be realistic about our ability to affect big change. And I'm particularly sort of disappointed to read the news this week about how real a lot of that is, because it really is important to these businesses. And you see what happens to valuations when that kind of thing happens, because what have you got now? You got a risk of much heavier regulation, market value gets smashed. Well, that's not great from a shareholder perspective, is it? So that's why we care about it both at the basic human level, but also at the shareholder level. We want companies to change their practices, because that's good business. It's good business. It's good for long-term sustainability.
Right. No, it makes perfect sense. And I think that, some of the work that we've done, of course, shows that sometimes it's hard to say that better companies on an ESG score outperform, but it's very easy to show that companies that have ESG controversies that blow it, basically, they get hit. And so it's real value. It can be destroyed there.
Yeah.
Well, what do you see next for the super fund? I mean, what is an opportunity or a trend that or maybe a risk that you're particularly on the opportunity side? What are you looking for next? What are you excited about in terms of what do you see coming on the horizon?
Yeah, so one of the big bits of work that we've done and conversations we've had with the board over the last year, 15 months, has been around a review of our responsible investment framework. So we originally created that back in 2007, and it's been sort of incrementally updated along the way. But we stood back and said, what's happened in this space, the responsible investment space globally with investors, though not just in the climate change area, but more broadly. And then also said, well, what do our stakeholders care about? Because this is certainly an area of just increased scrutiny for investors like us around the world. We've got, there's a lot of transparency. People can see our whole listed equities portfolio. We publish that on our website twice a year. And so people can go through that and then say, well, hey, you own this company and they've done this awful thing, and what are you doing about it? And we've had various presentations to our parliamentary select committees about our approach on this. So what we wanted to do with that was say, hey, there's a big trend from a sustainable investment perspective. How do we stay best practice? Because that's one of the requirements on us in our legislation. And how do we set ourselves up with a framework that's going to be good for the next 20 years? Because this has been a big trend of late, and you see it, every time you open a financial newspaper, there's a story on it. I saw today a headline, I haven't read the story, that GM is the new ESG play. So there you go, So yeah, every day there's a headline on it. So we did quite a lot of work on sustainable finance, and really there has been quite a big shift, and we agreed with our board a new sustainable finance strategy. And that shift from responsible investment to sustainable finance sounds a little bit semantic, but actually the way I sort of think of it, and you alluded to it earlier, Sarah, was it's a difference between, in an RI world, saying what's the impact of these things on my portfolio? What's the impact of climate change? What's the impact of social trends? What's the impact of governance, poor governance on the outcomes in my portfolio? And sustainable finance says what's that? So what's the impact of those things? But also what's the impact on those things of my portfolio. So the choices I'm making in the portfolio have impacts on climate change. They have impacts on social outcomes in terms of access to, good labour practices or good human rights, respecting human rights, or access to healthcare or water or inequality. All of these social trends. What are those things? So that's the shift that we're seeing. That's quite an important shift from that old RI world of what these things are out there. What are they going to do to me? To I've made some choices. What's that doing to the world in the broader sense that we are living in as an investor? So we've agreed in broad terms what that sustainable finance strategy looks like, but then we're in this conversation at the moment about what happens then. How do we do that? What do we do to the portfolio to try and improve the ESG profile? What do we do to the portfolio? What do we do in terms of our allocation of capital to impact things? So where you think about, well, we obviously want to make a financial return, but we're also got an outcome in mind, some other outcome in mind. And so that's getting a lot more focus at the moment from us. So I think that's a really big trend, and we're seeing, it's sort of, it started in the climate space. And climate, in a funny way, is easier because it's a single thing. It's got some metrics. You can measure stuff. Causation is a little bit more obvious. Social outcomes are harder. There's just lots of them. It's harder to prioritize, or people will all have different views of how priorities should be, and causation is harder. So, that's a more challenging space, but it's a pretty interesting space as well.
Well, that's fascinating. And I will be very interested to hear and follow the progress on that, because obviously you've been a leader in the climate space for a number of years. And so it's really interesting to see, what you learn and how you think about that as you think about expanding that and sort of shifting that to the sustainable finance. So, well, that's true. Well, thank you so much for your time, your insight today, obviously for your support of FCLT Global and your support of, pushing this idea of sustainable finance around the world, because I think that there really has been a shift, as you've said, over the last number of years. Probably when you started doing some of these things, people thought you were a bit of an outlier, and now they realize that you're simply a leader. So thank you for that.
Thank you, Sarah. It's been great to chat.
Thanks for listening to today's episode of Going Long with FCLT Global. To learn more, visit our website at fcltglobal.org.